This is the most important concept in accounting. In fact, it's so popular, it literally has the name the accounting equation. It's the first thing that you'll learn in a college accounting course, and for good reason. So much of finance and accounting revolves around this equation. And today, we're going to explain what exactly it means and why it's useful. Before we begin, be sure to download this infographic right here and the Excel file so you can follow along easily. Okay, so the accounting equation states that assets equals liabilities plus owner's equity. This equation to accountants is pretty much what E equals MC squared is to physicists. It's a way of understanding the financial universe that we're in. But before I can explain what this means, we need to define what exactly assets, liabilities, and owner's equity are. We're going to use an example of a business that goes door to door selling chocolate bars. Okay, let's start with assets. The literal definition here is items of economic value that the business owns or substantially controls. So what are some examples of assets for our chocolate bar business? Well, the most obvious is going to be chocolate bars, but companies oftentimes refer to that as inventory. Inventory is just one type of asset. There are a never-ending list of other examples of assets, like, well, my favorite asset, cash money. Any money that I have in my chocolate bar company's bank account is considered an asset. And to me, that's the most important asset of them all. But there are other ones, such as accounts receivable. Accounts receivable is like an IOU, where a customer agrees to pay me an amount in the future for chocolate bars that I may have already sold them. And these customers better be paying me my money. Okay, here's some other common assets that you may find in a business. So we all know now about one side of the accounting equation, our assets. What about this other side, liabilities and owner's equity? Well, if the left side represents all the items of economic value that the business holds, the right side represents how those assets came into the business. And it's split between amounts that are owed to creditors, which we call liabilities, and amounts that we owe to owners, which we call owner's equity. Let's start with liabilities. A simple example is any debt that the business takes out. So back to my chocolate bar example. If I take out a $10,000 loan to set up my chocolate bar business, that $10,000 is a liability, and I owe that money to a creditor who lent it to me. There are many other liabilities, though, that a business may hold, such as credit card balances or accounts payable, which is the opposite of accounts receivable. This time, I'm the one who owes the money to the vendor that I did business with. And here are a bunch of other liabilities that you may find in a business. The key thing here is that they represent an amount owed to a creditor. Now that brings us to our very last part of the accounting equation, owner's equity. This is pretty much what it sounds like. It's the amount of equity that the owners have a claim on. So just like liabilities are amounts that the business owes to creditors, owner's equity is the amount that the business owes to owners. So let's say I get an investor who believes in my chocolate bar business, and that investor invests $100,000 into my business. If I were to shut down my business tomorrow, technically that investor would be entitled to recoup that $100,000. But investments into the business aren't the only equity accounts. Another really important equity account to understand is retained earnings. See, our business generates income each month and also has expenses. The details behind the income and expenses get shown on a report called an income statement or a profit and loss. That all gets summarized via an account called net income. So if I have a positive net income, that means that my business earned a profit in this period. That profit is money that the owners of the business have a right to claim. If I have a negative net income, does that mean that I earned a profit? I'll give you a sec to think about it. That's right, I have a loss. And this loss or profit will get accumulated into an equity account that we call retained earnings on the balance sheet. This is pretty much all of the cumulative values of earnings that have been retained. And until they're paid out to the owners have a right to them. Now, there are a bunch of other equity accounts that you may find in the owner's equity section of a balance sheet, such as these over here. Okay, so now we understand what assets are. We understand what liabilities are, and we understand what owner's equity is. What's so special about this equation? Well, This equation helps us understand how to read a balance sheet, which is arguably the most important financial statement in a business. It also helps us understand a concept called double entry accounting. This means that every financial event that takes place into the business affects at least two sections in a balance sheet. Let me show you an example. So let's say I buy 100 chocolate bars for $1 each. I exchange money, an asset, for chocolate bars, another asset. My money goes down, my chocolate bars go up. So these two events cancel out each other. Now let's say instead I buy those chocolate bars on credit, which we call accounts payable. Well, in this case, my assets go up. I have chocolate bars, but I didn't spend money yet on it, so my liabilities go up. As you can see, this equation never lies. Assets equals liabilities plus owner's equity. Okay, we're gonna go over one more example. Let's say I sell 10 chocolate bars for $2 each. My income now goes up by $20, which is another way of saying that my retained earnings goes up by $20. As we said, retained earnings is an equity account. If I put that cash in my bank account, well, that means that my assets now went up by $20 as well. So again, assets equals liabilities plus owner's equity. Let me hear you say it. Assets equals liabilities plus owner's equity. Louder for the people in the back. Nice work. Now you can call yourself an accountant. And you'll see this equation comes up time and time again in everything that you'll do in finance and accounting. Thanks for tuning in today. If you enjoyed this video, go ahead and hit the like and subscribe button. It makes a huge difference and is a free way to show your support. And I will see you next time.